Good afternoon, everybody. Welcome to our Tuesday afternoon bull sessions for March 22nd, 2022. My name is Mark Robertson. I'm a founder and managing partner of Manifest Investing, and I'm joined here by my dear colleague, just slightly to the north of us here, Ken Kavula. Good afternoon, Ken.
Good afternoon, Mr. Robertson. We're far enough north to have a difference in weather
Yes.
for the last couple of days. I'll tell you, you were nice and sunny and beautiful down in Rochester yesterday, and we were just kind of hovering in the high 30s yesterday, and another 50 miles north, and they were getting measurable snow yet in the first or second day of spring. So certainly strange weather in Michigan, a 40-degree temperature differential between where Mark lives and about 120 miles north of him.
Just amazing,
So,
yeah. And
yeah.
for those of you in the southern half of the country, you're probably faced with all kinds of precipitation and calamity. So our heart goes out to you, and let's hope it all behaves itself. Now, Kim is with us. I don't know if she's going to be able to join us. She might check in, but hope everything is going well down there in Florida also. All right, so today you will notice that the river is no longer green. We were able to remove the food color, the green food color from that, whatever that is. Is that the Red Rock River behind there? I don't know. Anyhow. All right, let's go ahead and let's dig into a few things. This notion of keeping calm, we've been talking about it for weeks, and boy, if you kept calm and accumulated, I told you last Tuesday I had just picked up a few more shares of VGT, a technology ETF, and a few others. And boy, I guess when word got out on the street that I had bought that stuff, Ken, all the clamps came off.
They followed you then, Mark, right? A market maker. We should get you on the closing bell program now, and Sarah Eisen will proclaim wonderful things that are happening until you're wrong, and then she'll spit you out and push you to the curb.
Then I just changed the story for the same exact condition and come back and get praised.
All right.
All right, so we're going to cover a little bit of chippiness. We've already been chippy a little bit. Chinese lodging, that's kind of a play on the GreenTree company in the best small company portfolio. A few moments with some wizards and their wisdom comments at the end. The mountaineering refers to, and thanks to Len Douglas, we're covering Allegheny. That happens to be the Allegheny Valley in Virginia. And do want to talk a little bit as we close here, just to put everybody on notice that we will probably be taking, not 100%, but probably 99.4% sure that we will be taking a closer look at that book, Expectations Investing. And Kim, if you're with us, feel free to chime in on any thoughts you might have on the book so far. But
Mark, before we get our audience chipping at us, is the Allegheny Valley in Virginia or is it in Pennsylvania?
I think it's in both.
Okay, could be.
The picture said Virginia when I grabbed it, but I think both is actually technically correct. And China's just a mess, and that picture in the middle captures it fairly well. That's only a few days old, and COVID stuff is happening over there. So let's go ahead and get underway. You guys all know the drill. No investment recommendation is intended. This is all about demonstrating and illustrating the processes, techniques, methods of the Modern Investment Club movement as interpreted by us at Manifest Investing and the Modern Investment Club movement. So you're going to hear opinions. Please do your own homework before making a decision about any particular potential investment. If we own it, we'll try to tell you that. Try to remember it anyhow. We're 1 week away from the roundtable. We'll have a reminder in a few minutes. If you'd like to be added to an email reminder list, you can send an email to nkavula1@comcast.net, and those are a monthly program that we put on. By the way, Ken, our rate of return, our relative rate of return, had bubbled up pretty close to 6 percentage points in this market volatility. So we may have extra celebration in mind.
As long as we stay above that 5 mark, I'm really happy, Mark. I'd love to be at 6 or 7, but 5 is a great goal, and if we can hit it, that's wonderful.
there is one stock which we might talk about here this afternoon that's really helping. And there's more than one stock, but we might talk about one stock. And our 2 email addresses are at the bottom there if you have anything else on your mind. All right, here's our quick look at a chart for the past week. While we were wallowing mid-afternoon last Tuesday, like I said, I put in my buy orders, and the market took off. So I'm taking credit for this one. And it went up quite a bit, as much as 8% for the NASDAQ since we had gathered. It's actually almost 10% from the morning of the last bull session. So hopefully you've been enjoying some of that, Ken, and we're going to actually look here in a second at how Groundhog Nation has been enjoying this, but it's done pretty good things to a lot of portfolios here over the last few days.
Well, there was a lot of doom and gloom. We went out and did some errands this morning, and so I was listening to CNBC in the car, and boy, there was a lot of doom and gloom. It seemed the better the market got, the more negative all the guys that were talking about the market got. So it was kind of depressing, in fact, to drive home and listen to everybody tell me to just hold on a minute because things were going to get really worse before they got a lot better. So we'll just have to see. I guess I'm prepared for either direction. My long-term experience makes me kind of immune to worrying about these sudden ups and downs. And the portfolio is big enough that it doesn't move as quickly as it used to in either direction. I think some of that has to do with the fact that I'm buying larger stocks with a little bit more safety net attached to them and a little bit more dividend attached to them, trying to keep the portfolio relatively stable as I move into my very golden years.
Okay, take me with you. Yeah, and this newsletter writer is actually, he's one of them that is warning about the problem underneath the problem. And yeah, to say that some companies are going to be challenged, that's always going to be true, right? But the thing, like if you're driving around in your car and you're hearing the same thing Ken is hearing, it's never as bad as they say it is, and it's never as good as they say it is. So just, you know what, find an excellent company at a good price and be happy.
Well, to me, Mark, it's almost like what do you call it when the it's all counterintuitive. That's the word I was looking for. That the more negative contrarian. That's a good word also. But the more negative the talking heads seem to be, the more that the less that I worry about what might be happening in the next couple of months. When they become really, really happy, I think that's the time to consider lightening up just a touch and taking whatever some of your gains are and being happy with some of them. I think that certainly was the attitude last September, October, probably into November even. Things were going to be just perfect if you can think back that long and think about the things that have happened since then to destroy that story.
Yeah, in fact, we looked at it a little bit last week. The Russell 2000 growth topped out, and people were euphoric back around Halloween when we had to pick our stocks, and it actually had quite a haircut since then. All right, well, here let the celebration begin. First of all, it's been quite a week for Groundhog Nation. We got down to about minus 14 on the overall, the average for everybody that's playing along. You can see that we're back to minus 5, which is still not great, but it's a whole lot better than minus 14, especially in a week. And a number of people are stepping up and beating the market. Now, Ken, I think you actually slipped up. You're pretty close to taking out the 5,000.
I'm just 3 beneath right now. I'm in 40th place. I will remark that I don't see any other groundhoggers. I'm sorry, I don't see any other knights on the list here, but I see Kurt way up here at 28th. So maybe we need to invite Kurt to the next roundtable, Mark. What do you think?
Yeah, well, that could work too, but I'm coming.
Yeah.
I'm coming. We'll get to that in a minute. But the one thing I notice here, it's almost like cue the Jaws music because Mark's moving up the list, and also look at the clubs. Look, it's like the clubs are just like rolling up the list here, and you may recall from a couple weeks ago, all those rhinos that were at the top and notice that they're kind of fading a bit, including Graham Stephan's Monkey down at 35. So, all right. And today's big winner is Sean Mace because it's his birthday. So Sean's birthday, he's actually moved from 22nd this morning to number 7 right now. So he's having a good birthday in the groundhog leaderboard anyhow. So I'll be joining this list here fairly soon, by one way or another.
And I think, Mark, it's important sometimes to recognize continued excellence. And, you know, I don't care what year you're in and what contest you're in, that Northern Traders Club from Traverse City, Michigan, seems to always be somewhere up near the top of the list.
Yeah,
that's one of Herb's clubs, Herb Lemkohl's clubs, and they just seem to really know what they're doing.
Yeah, those 2 little stars means they've won it twice. So not to be taken for granted. All right. So, yeah, and then we'll come back and take a look at Kurtis Sears. Kurtis Sears he was a champion a couple years ago, and he's been at the top of the leaderboard for 3 or 4 years now. So kind of interesting to watch what he's up to, and we'll take a look at one of his holdings here in a minute. Well, Len Douglas, this is why I said your ears are burning. This is a post from the Manifest Forum, and we had talked last week about maybe don't chase Occidental, but instead be looking around for other companies that Berkshire Hathaway might be willing to buy. And lo and behold, they went out and bought, I believe it's $11 billion is the price of Allegheny. And they've been on quite a run, and they have almost $150 billion in cash. I think that's even after Occidental. So yeah, apparently they're ready to go shopping a bit. So,
I'll tell you, the folks at Berkshire Hathaway, Mark, are still able to surprise because, frankly, another insurance company is not exactly where I would have begun my search looking for what Berkshire might want. It was a big surprise to me when I heard these announcements. Big.
Yeah, and this is what kind of leaped off the page at me. He's only been watching it for 60 years.
He watched it as a competitor and evidently had a lot of respect for it.
Yeah, so he basically jumped in. I think one of the head guys at Allegheny is a former Berkshire, so it's a homecoming of sorts. But this is the news, and it pumped it up about 25% overnight. Company, as you pointed out, Ken, very much like Geico and Gen Re. It fits right in with some of the other stuff that they're doing. Here's the page, the value line page. And I guess the thing that kind of grabs me is I'm thinking about leafing through a value line. I wish I had a hard copy to do this with just for old time's sake, but leafing through the pages, you look at this long-term trend here, right, through the price, and then you look at what's happened here recently, and I really think it's really not much more complicated than Buffett and his investing gang saying, I think they're going to go back here in some way. They're going to return to that, and they're down here now. And they obviously can put some math to that, but that's basically what they're looking at, what they're seeing, and they're betting on a return to that in a business that they know how to run, and they know whether it's being run well, and they certainly understand it. Here's a look at the company showing that it has been a very steady company at the top line. That's book value for a financial at Manifest, but the book value has been fairly steady, growing at about 6%. And again, what I believe, and you may not be able to see it here from this trend down here, but I believe, again, the crew at Berkshire Hathaway probably believes that this company will be capable of returning to that upper zone for return on equity. And if they do that, it's quite a good investment, and some pretty good numbers from top to bottom there.
I find myself sitting here, Mark, and not listening really to what you're saying about Allegheny, but riffing in my mind about what you just said about the value line. Well, no, what you just said about the value line. I'm wondering how many kinds of great experiences the younger generations have lost by not being exposed to newsprint and printer's ink and old books that you've read for 6 or 7 times. They all have that certain smell and that certain messiness to them that really kind of immerses you in the product and and really draws your attention to what's going on. I agree with you. I miss the days of wetting my finger and turning one of those flimsy newsprint pages looking for the next great thing. It's a lot more romantic than sitting by a keyboard and waiting for something to light up, you know?
Yeah, but you know, that newsprint doesn't play music at me though.
You're right. You're right. No music, but a lot of blue light coming at your eyes. I still wonder if that's the reason it takes me an hour to get to sleep now than when I used to be able to go to sleep in 5 or 6 minutes. Maybe, I don't know. We'll
There's a
see.
lot to be said for that. Kim Butcher actually
Yeah,
checks in and says she has an article of what Buffett probably saw in Allegheny, and we'll actually add that to the notes on the forum. And
tremendous, tremendous.
all right, let's talk a little bit about Kurtis. Kurtis has been at the top of the leaderboard now for 3 or 4 years, as I just said. His picks for this year were pretty aggressive, a little bit unconventional. Dutch Brothers has been added to coverage as a result of his selection. Some of these are actually going to go up. We're at that point in the first quarter when we kind of flip on and ratchet up the coverage according to the analyst consensus of estimates for the next year, as we go through and update all the value line numbers too. So some of these will actually look a little bit better with another year or two in the projections column. Well, you'll definitely see that for Outset. I want to take a closer look at Bill also. But NVIDIA shows up on here. That'll get a little bit better with the next update. We're going to talk about that in detail. But the other one that kind of jumps off here from a chip standpoint, and I think this is a worthy study, I think that's a chip company. Probably.
It is, Mark.
Well, that's not the Marvell that I know.
Huh.
It's not.
I'm going to back off. I'm going to back off, Mark. Now you've put doubt in my mind, so I'm going to back off. I'm not sure now.
It doesn't. That's not a comic book company.
No, I'm sure that's not a comic book company, but
Just kidding.
we just studied Marvell, but I don't know if that's the ticker we studied or not.
It is. It is. That's the chip company.
Okay.
It's
All right.
definitely a worthy study in the electronics / semiconductor realm. It's a good study.
So
And since that one is down, since Kurtis picked it, I think it's probably worth a run up the flagpole.
So the opening line in my partner's study for Marvell, when he presented it to the club, it still works then, right? He opened his presentation with the sentence, says, when I got assigned this stock, I thought I was going to be looking at comic books. So, yep.
All right, so let's take a look at NVIDIA. And one of the reasons I wanted to do this is, first of all, if you didn't know this, a week ago it was at 210. And it's back at 270 that you see up here. So at 210, it was getting quite interesting. And so Herb Lemcool pick for the roundtable that's actually performed quite well. Obviously, these guys have launched. They are integrated into a whole bunch of the Internet of Things / Bitcoin / all of that technology that's associated with cryptocurrency, and a whole lot of involvement in all kinds of high technology stuff. Just an interesting.
And high performing chips for gaming also, Mark.
Yep.
That's still a big part of their business. Gaming chips are still something they're dealing with. I'm going to ask you a question, Mark, that I don't expect you to answer right off the bat. Do you think NVIDIA might be one of a very small group of companies, maybe another is Costco that comes to my mind, that might never show buy on a traditional stock selection guide or on a traditional set of analysis, and yet it seems to just keep making money and keep making the people that own it rich?
Yeah, I'll go ahead and take a shot at an answer. Again, I don't know, but I do know one thing that I do know is anytime you have a growth trajectory like you see here, on the left-hand side of this chart, it really does challenge Morningstar. It challenges Value Line. It challenges a large part of our community. Early stage companies, rapid growth companies can be really difficult. And that's one of the reasons I wanted to point out here, because in the last quarter for NVIDIA, the low price forecast at Value Line has done that. It's probably still not high enough yet. And the fair value at Morningstar has done this. So that's what I meant about these boosts. Just kind of, the boosting has reached escape velocity, hasn't it? And,
Well, we've spent so many years convincing people that a large company could not maintain a sales growth of 19 or 20 or 22 or 24%. We spent so much time convincing beginners that they have to estimate their sales growth at a lower rate because it's unsustainable. And so when you come across a company where that growth is sustainable, and especially when it's a large company, it's really difficult to buy into it. I think that's exactly the problem that Value Line and Morningstar are having. They know what their models are based on, and they know that this is certainly an outlier when that model's concerned.
yeah, and the thing that's really tough to call, first of all, you got to look at the total available market for a company like NVIDIA, and it's humongous. That's one of my grandson's favorite words, humongous. And I learned that.
Grandpa.
And then what you want to notice is, yeah, it's tough. And even with the 3 to 5 year forecast at Value Line, the growth rate shown there in that circled area still is 16, 17%. And the other thing that is a reality with companies as they mature is this probably is something like of a plateau for a company like this and improving its profitability. I don't know that that's the case, but there's a plateau, an unknown plateau somewhere there. So this stuff all gets pretty challenging, and it does have impact on the numerator for the projected return on value, but notice that these numbers have actually been fairly steady. And again, something that we've covered in great detail here. And one of the reasons that it's still in the roundtable portfolio with Herb Lemkel's name on it. So good stuff. All right, let's switch gears and talk about best small companies. We actually had a pretty good week. The Russell 2000 growth was actually below 1600, which is a bear market. So that's why I took away the bear and put in the waving cat. Sean Mace tells me I'm no longer to use dead cat bounce in my references. So that's not a dead cat, but it's bouncing.
Is that a microaggression when you do that, Mark? Is that what that's called?
So we're not back to where we're beating the market, but not doing too badly. And we've got quite a bit of hope for the companies on this list, with the exception of one, and we'll talk about that. But any other thoughts on the list, Ken?
Well, I don't understand people. I guess I do understand people throwing out the baby with the bathwater to really get the most out of a really hackneyed phrase. And I just think that what's happened is that they've looked at stocks and they've said, if it doesn't have earnings with a big PE, or even if it does have earnings with a big PE, or if it's small to the point where we can't really find a lot of news about it, we're going to sell it right now. I just think that the mood of the market is kind of anti-risk when it comes to companies with no earnings, or with earnings that are just beginning, or with a fairly small piece of history behind them. I think that'll change. I think that'll move itself around. I noticed that our banks, as far as relative return, are moving back towards zero. They had gone pretty negative there for a while. I see Merchants Bancorp right smack dab up in the middle with actually a positive relative return right now. So, and Axos, it has moved from double-digit negative relative returns to only a negative 4% relative now. I still think the banks are really good investments long-term, especially the regional banks. I guess there's a few on here that I haven't liked from the beginning. and I still don't like a couple of them. But for the most part, I like this list, and I have some confidence in this list.
Well, I've looked at all of these here, these 5 at the bottom, pretty carefully, and I'm pretty confident that they could even have catalysts and turnarounds in the coming year. The business case has not changed for them, so I'm pretty comfortable with them. Which brings us to one that he was making a veiled threat there, audience. Mentioning companies he doesn't like. GreenTree Hospitality. Here's the situation that we actually looked at the beginning of. Well, this is last Halloween, and where I made the case for the company. It's completely concentrated in China. It's one of the largest hotel firms in China, and you can see that they had a rough time in 2020, as you'd expect. And the thesis was, when COVID gets solved, perhaps travel and leisure in China recovers. No way to know when, but that was the thesis. And here's what we're faced with today. And this is kind of my impetus for suggesting a sell of GreenTree. First of all, China's bothering me. Second of all, this picture is from just a week ago. They are back into a lockdown phase, and I just wonder if the catalyst can reasonably return this year. It could, but I'm concerned that the catalyst that we hope for is certainly lingering off in the distance at this point.
What bothers me, Mark, is that Russia and the Ukraine have pushed COVID off the front pages. And it's easy for us to think COVID is now in the rearview mirror, but I wouldn't want to contemplate what would happen if a new variant that evaded all of our vaccines, or a new variant that was more virulent than the most recent one that's kind of spread around, this Omicron one, if that attacked the world. I still think that we're kind of in an unknown era as far as these pandemics are concerned. I mean, people kind of compare it to the Spanish flu pandemic back in the 1918, 1919 time period. But ask yourself how long it took that virus to come across the ocean at that point. There's no ocean, there's no protection anymore. There's nothing that's going to stop that virus if it's more benign or if it's more virulent. There's nothing that's going to stop it from moving all across the world yet again. I have a problem with this graphic, and I have had since we presented it. I think that's some really creative net margin projection there, Mark. So,
well, the thing that got me as I was sitting down to do this, I was going to try to update the analyst estimates and take a look at it. And then I just kept hearing this little voice. It doesn't matter. It doesn't matter because they might not be telling you the truth.
yeah.
And it doesn't matter because this stuff is going on. So again, I say we dump it and we go shopping, and that's the subject of this slide.
I agree, and I would ask everybody to draw their attention to the prove numbers in the right-hand column, and look at the prove value for Green Brick Partners, and then ask yourself which of these values is basically data-driven, and we kind of think gives us a fairly good read on future appreciation. Well, it's prove. And if it's data driven, it needs data that speaks the truth. And I'm not sure that we can say that about the data that we're using to calculate prove for Green Brick. We have examples, lots of them, where the data coming in from Chinese companies specifically has been creative, to say the least.
Well, keep in mind that's Green Brick Partners. That's not GreenTree. That's not the.
I'm sorry. I'm saying GreenTree, Green Brick, right? Green
Yeah.
Brick. I'm sorry, Mark.
Yeah, and the numbers are high. I mean, we can go in and do a forensic to see. I think there's probably a fair amount of cash involved there too. But yeah, the numbers are high. The numbers between the projected annual returns and the proves are actually fairly consistent, I think. which means those PEs probably are somewhat reasonable. Certainly worth studying a little bit closer. I'm only familiar with a few of these companies. CoreCard did appear in a number of groundhog portfolios, so that's probably worth a closer look. Matt Spielman did Victory Capital at the last roundtable, so that's definitely worth taking a closer look. And then these two, I think, can definitely fit into the theme of EV/infrastructure/residential and construction, residential and commercial construction, because they make wires and all the electricity stuff, from conduits to the actual copper. And both of those companies are at least compelling from a theme standpoint. But I'm telling you, Ken, I hope to pull up this list, which is basically based double-digit growth, reasonably high quality, hopefully above 60, and obviously the decent returns, either prove or projected annual return. I was hoping that a Neogen or a Simulations Plus would jump off the page. It's not doing it yet, huh?
I'll tell you where I'm going to start my dive mark for the next groundhog for the next week from now is I'm going to start it by looking at Sportsman's Warehouse and Capital Bancorp. And the reason that I'm going to start with those two is the consistency of the par value with the prove value on those two companies. I like it when those two numbers are very close together. I think it tells me that I'm looking at an analysis that probably is as spot on as it can get. Now it could be just blind luck as well, but I think that's where I'll start my searching for greatness with those two companies, only because of that par being so close to that proof.
Yeah, and the other thing that kind of jumps out at me with both of those is the low PEs. I mean, those are pretty low bars, 9 and 11.
I didn't even get that far, so you're absolutely right. Absolutely right. Yeah.
And Technoglass is compelling. I don't know much about the company, but that's definitely compelling. And Pubmatic, if for no other reason than St. Patrick's Day was last week, and I need to know what Pubmatic is about. All right, so we will be shopping there. We'll either make the decision in the forum or next week at this gathering. Okay? And if anybody has any comments on any of these, Semler, yeah, I know Semler. It's one of my groundhog picks. That's the at-home cardiac test and blood test stuff. So we will be looking at those. Just a reminder that our April roundtable will be our special edition, and starting early with an educational program and then going to a traditional roundtable. We will have Candace Baker joining us from the St. Louis community of volunteers. And there's a reminder that we are 1 week out from the March roundtable also. Again, anybody can access that through the public link at the bottom of the page. All right. And here's our moment. I just want to point out that at the most recent roundtable, which happened to be on March 1st, that 6 stocks were presented, but one of was basically not allowed to be voted for by the audience in the audience poll. And I'll let you guys all just kind of scan the numbers down here to see which one you think was not allowed to be voted on. And you can draw your attention to this up 41% in 21 days. So, yeah, this is one that we are watching fairly closely. We'll probably have a little bit more to say about our Ardelyx. That's the obviously very early stage speculation.
Now, Mark, which of the knights in the green room volunteered their stock for non-posting in the poll? I forgot which of the knights was.
A little hazy on that one, Ken.
Were you? Okay, all right.
I never get any votes anyhow, so why waste the keystrokes?
Oh, you poor man! You know.
I liked PayPal a lot, and that one's doing pretty well too so far. But it's okay. Enough of that. But Ardelyx, we have a fairly sizable stake in the round table, and that is helping to propel it back to 17% and beating the market by almost 6 percentage points the last time I looked. All right, I thought we'd spend just a couple minutes and we can wrap up with this, Ken. This is a little snippet from Visual Capitalist that I ran into. The quote is right. The The link to the page is right there if anybody wants to go take a closer look. But we're going to present the whole thing. 5 top investing quotes just to scratch our heads over a little bit. So let's go ahead and get started. I really like this one, and this is really one of the most challenging things for any investor to muster, in my opinion. And it falls right into that patience and discipline category, and certainly does a nice job of capturing how different the last year has been in that respect, in terms of hyperactivity, potential hyperactivity. But since Buffett's leading our contest for 2 years running now, pretty interesting quotation there.
I'd like to put up a candidate for number 2, Mark, because I think number 2 is memory. I think it's important to remember what's happened in your investing career, and to keep some of those lessons in the front of your brain, because I think that makes you a much better investor, and it plays into this patience and discipline idea that we've always been talking about.
You know, I think there have been a few times I'm not quite as experienced as Warren Buffett, and almost not as famous either. But I can remember waiting almost 20 years for a stock, and it can actually pay off to wait that long for something to become attractive the way that we view things. So interesting stuff. All right, the individual investor should act consistently as an investor and not a speculator. Yeah, you want a core. You definitely want to have a core. And we might actually expand on this with a little more time next week. But Benjamin Graham, basically the mentor of Warren Buffett, and that intelligent investor we've discussed a number of times. Maybe we'll pull that off the shelf too here in coming weeks. But yeah, this one actually dovetails pretty nicely, in my opinion, Ken, with that slide where we showed how wonderful those positions had performed in the round table over 12 years.
Yeah. I think also we should place Graham in context. Remember, Graham is writing in the early 50s, and he's basically defending investing to a community that had turned themselves off. The average person in the early 50s was pretty anti-stock market. They had seen what had happened in the late 20s, early 30s. A lot of them had come to their maturity during that period of history. And Graham was one of the first people to basically defend investing in a rational way. He was somebody that didn't really understand speculation, and in fact made a lot of comments about how there was nothing really to understand about speculating. It was pure luck and by gosh and by golly kind of smoke and mirrors. And Graham was the first one to put together a method of evaluating stocks and then using that evaluation to make your choices. So he's a pioneer. He's so much of what we do today in better investing and in manifest investing can be traced directly back to Benjamin Graham.
Absolutely. And if you extend that to the work of David L. Babson, T. Rowe Price.
Absolutely, yeah.
Maybe we'll do a session on Walter Schloss too at some point.
Well, and I think that we have to include Sir John Templeton in that whole mess of people as well, and make it clear that a lot of things that we take for granted today weren't even known or weren't being used by the average investor 40 or 50 or 60 years ago. So we have to, I think we have to explain maybe how groundbreaking it was to think of index funds. Those are not something that have been around forever, folks. This passive style of investing, and that was revolutionary at one point. I know that it's pretty vanilla today, but it was revolutionary.
Absolutely. treasured the moments that I did have with Jack Bogle. All right, number 3, the biggest risk of all is not taking one. Yeah, you got to step up. I love this one, Melody Hobson. I've spent time with Melody Hobson. Have I ever told you that story, Ken?
You've told it to me, and I've told it back to you that I've spent time with Melody as well. We had communications with Melody Hobson at a couple of our conventions that were held in the Chicago
Oh,
area.
that's right.
And in
Yes,
fact,
you
we
did.
ended up with one of her partners as a speaker when she had to, when she couldn't make her calendar work for us. She works with Ariel Capital Management, which was the name of it at that particular time, and a really a fresh voice, and we're talking now maybe mid 2000s, 2002, 3, 4, 5, something in that range, but a very fresh voice for people taking a deep breath and understanding that there was a method to evaluating stocks and to creating portfolios. It wasn't based on a dart throwing monkey.
Mm-hmm.
It was based on some rigor and some discipline and some patience. There we are, back to those same 2 words again.
Well, earlier is always better. My experience with Melody goes back to the late 1990s in Chicago for a program we called the Breakfast Club. And
Yep.
she and John Rogers were out from Ariel, and I was part of the planning for that event thrown by the Chicago chapter. And I made the mistake of scheduling it on the day before Easter. And it was funny because, I mean, John and Melody were like, Mark, why'd you do this? And I said, well, and then the whole chapter came over and said, well, Mark's no longer responsible for this. We'll let him do some other stuff, but he's not going to do scheduling. But yeah, I mean, she's got quite a perspective, and the impact she's had on getting started earlier and getting started at all is extremely important. All right, love this one too. Timing the market beats timing the market. Ken Fisher. I actually don't care for the way this is often presented, but I think I'm okay with this one. This artificial construct of missing the best 10 days of a decade. But this is a pretty massive picture we're looking at here. And it just basically makes the point that you just invest regularly, please, because nobody's good enough to capture that.
I think also, Mark, this quote captures the magic of compounding as well. And I think Fisher is one of the people that likes to remind us, if you're dealing with him and his companies, likes to remind us about how compounding can work. He has a lot of material out there that talks about people getting a little bit of money started in an account at a young age rather than a moderate amount or a lot of money started at older ages. They seem to work out better the younger you are, the faster you start. I could pair this with a quote from Tom O'Hara, who was the guru, the leader, the everything to better investing for over 50 years. When I sat next to him at an investors fair and complimented him on his skill as an investor, he made it quite clear that he thought he was a fairly average investor, but he had stayed in the market through thick and thin, and he had lived a long time. And he thought that's what contributed to his nice big nest egg when he was in his late 80s, early 90s.
Well, I personally helped him sell 10,000 shares of EMC, so he did okay. Yeah, Ken Fisher, another anecdote. Ken Fisher was the headline speaker at one of the conventions. I believe it was in Philadelphia. And about a month before the program, he actually rerouted his airline arrangements so that he could spend time in Detroit. He stopped by the office just to get to know us and the audience better. I thought that was like first class. And he can be kind of abrupt and quite challenging. And in fact, you may remember, Ken, we actually had Ken Fisher participate in a review of his book, the 3 Questions book. This goes back almost 15 years ago now. And he actually showed up in the forum, and it's one of the better. I'll put a link to it in our show notes. And it's a long, lengthy thread, but boy, there are some nuggets from some really, really smart people in that.
Yeah, abrupt is a really good word to describe Mr. Fisher. He tried to do commercials for his own firm when they moved into trying to gain clients through different media sources. Those commercials are still going today, but you'll notice that Fisher is not part of them anymore. The message is still the same, but Fisher has now been replaced with people that have a little bit more smile on their face and a little bit more easiness with an audience. Fisher always impressed me as being a little bit nervous in front of an audience, and that is telegraphed a lot of times when you're speaking, and it's telegraphed in a negative way a lot of times if you're nervous with the audience.
Yeah, even back when he participated on our forum, I warned everybody that, you can tell him you think he's wrong, but you better bring it. Yeah, and he will listen. I mean, if you say you're wrong and here's my data, here's my interpretation, he will have that all day long. But if you just simply say, I don't like you, you're wrong, he will chew you up also. But yeah, another name that we might drop is his dad. Phil Fisher belongs in that group of people we were just talking about a few minutes ago. Phil Fisher on investing.
Yeah, it's a real skill to learn how to beat people over the head with a smile on your face,
I'm used to it from our car trips. All right, number 5, it's better to be roughly right than precisely wrong. I think other people have used that on me before, so I like this one too, Ken.
This is my favorite of the whole group, Mark, and it plays right into our all of the different models that we've created and that we use. We always make it clear that there's gray area around the edges of all of our models. We do calculations in crayon. We don't use number 3 or number 4 pencils to write with because we understand that at almost every step of the way, even if you start with real data from a real balance sheet, you're still making judgments, and those judgments play into, in a big deal, they play into what the final results of your analysis are going to be. So I like this. Let's not sweat some of the details sometimes, and I know that's not going to sit well with some of you in the audience, but I can't tell you how many times I've had somebody ask me a question about a number so obscure in an annual report that I couldn't even figure out what they were speaking about. I think no matter what the company, if you want to put its feet to the fire and find bad numbers, I think you can take the annual report and find something negative almost. You got to search real hard for it, but you can find it. And let's just not sweat some of that stuff sometimes. We know what a good, high quality company looks like. And when we make a mistake, I think we're big enough to back ourselves out of that mistake in a reasonable time period so that it doesn't destroy all the rest of what we're trying to do.
Yeah, I can remember back in our Chicago club, we had a person that we finally figured out if they were really optimistic and wanted to sell a stock to the club, they would read the Bulls say part from Morningstar. And then if somebody nominated one that they didn't want, they would read the Bears say part. So, and I always used to tell people, if you want to be talked out of any stock, just read the 10K risk section where they have to do all their disclosures about side effects and everything else. So
it's like the drug commercials on TV today, Mark. Why would you ever want to take any of those drugs after they tell you all the things that could happen? I say to myself, my goodness, if even one of those happens, I'm not feeling very good about this drug. Why would you want to take it?
No, you might feel better in the morning, but you might also be dead. But And of course, the counterpoint to that is Hugh McManus was talking about the people running around in the sunshine with smiles, and he was going to take a drug for an affliction he didn't even have because it just looked too good to be true. All right. We'll probably come back to those in some shape or form. There's obviously some depth that we could go into that we didn't hear. But we did want to make everybody aware that, like I said, there's a 99.4% chance we will be talking about this within the next month. And might want to grab a copy of it and take a look. I did a cursory look at it. Kim Butcher and her book club are actually in the process of reading it right now. So she may have some interesting areas where that has taken them. Michael Mobison is influential and directly related to the Morgan Stanley Counterpoint funds. Counterpoint is a sub-advisor to Morgan Stanley, and they have some exceptionally high returning funds that show up on our fund manifest commonly. So that alone makes it worthwhile to look over his shoulder. And I have already found a few nuggets that will definitely come to the top. Alfred Rappaport probably fits in that group of people we were talking about, but he's relatively unknown and pretty obscure. But he's probably 90 years old now. He's a former professor at Northwestern's Kellogg School of Business, and he's notorious and famous for basically exploring the difference between price and value creation. So I think there's some stuff in here that might pan out pretty well for us. So keep that in mind. I definitely will have a copy of this probably before the end of the day. All right.
We do have some pretty interesting questions here, Mark. So if you're ready to close up, maybe we can talk a little bit about some of these questions then.
Okay, let me just wrap up by reminding anybody who might be watching that we do archive all of these on YouTube. If you just search for Manifest Investing, all of the bull sessions and roundtables, and Sean has been putting some 60-second shorts, which are kind of fun, kind of quick, down at on that same page. And just subscribe to that, and we'll let you know anytime new content is added there. And last but not least, it is March Madness, and I just thought I would share Mr. Vital and just point out that his bracket's not doing any better than mine.
I think his winner is gone, isn't it?
They are all gone. Kentucky and Iowa lost in the first round. Tennessee in the second. Gonzaga it's out of Spokane. Gonzaga is the only one still surviving, and they were hanging on by their fingernails in the first round. So it'll be.
I still love Dick Vitale though. Awesome, baby. I still love it. So.
All right, so I'll go ahead and shut down the recording, and we can stick around and field some questions.